guys, welcome back to the Capital Mindset Show. Today we're going to be doing another subscriber request, and I'm going to be kind of hammering out this week, or at least the beginning of this week, more along the retail stocks. So this one, you guys already know the title. It's Shopify. I'm going to start off this week with one of my first loves, and I'll kind of explain a little bit about what the original thesis was, and I'll say right now, it was a little bit more luck more than anything, if I had to say, as to what caused my success in this stock, because it was actually a stock I bought pretty much early on, prior to having any of the understanding I think I have today, right? But we'll go over that, and it turned out really well. It was a really good changer in terms of my net worth overall. Really propelled me in a positive way. So we'll again discuss some of the things that were interesting back then. Why did it work out the way it did? And then as I learned more, why did I end up taking profits when I did? Of course, having to pay that hefty tax burden. It wasn't all taxable, because I did have a Roth IRA contribution that a significant portion was actually dedicated to this stock. And I'll tell you a little bit. Well, the other one we're going to cover later this week is Mercado Libre, which is another one that was pretty much the same thesis. And if I had to pick the two today, I'll just say I am more excited about the potential for something like Mercado Libre in where they operate than something like a Shopify. Of course, I will express those concerns at the end of this video regarding the risks associated with Shopify. In the beginning, we're just going to talk about the business and the like. All right. So before we begin, or as we begin, I will share with you the price action today. Okay. So the price action is kind of wacky today. Google is calculating, Google's doing some weird stuff. It's like down 10% or up. Yeah, it's kind of behaving weird. I don't think it's actually down 10% today. But regardless, that's not the point. The point is, over the longer time frame, it's actually performed excellent, really well. And again, this was one of my first investments regarding this e-commerce play. It was back actually in 2016. And I didn't sell at the very top. I actually sold in 2021, right around here, right before this pop-up here. And I remember that feeling really well, because I felt really stupid because it popped the next day. But you see, like, it popped a lot, right? We're talking like so you remember those the most, because you always feel like a complete idiot. And then obviously, like, I thought it was going to continue up, and it did for a while. Like, look what I missed out on. Like, I don't know the exact price dollar amount, but it was around here. And you can see I missed out on 40% gains for a while. Of course, like, that's where, like, oh gosh, I shouldn't have played with the soap. But here's the thing. I'm not that guy. Most people are not going to be that guy that knows, okay, oh, it's going to go up 40 extra percent and I'm going to sell right here. That very, very, very few people are going to be that guy. And if you are that guy, you're probably just lucky. So, and then, obviously it corrected from here, but there's no telling. So basically, if you operate from the assumption that you invest based off of where you're comfortable with at that present moment in time, I wasn't comfortable with the future projections that I could model out about the business. And then again, thinking about some of the concerns, which I will discuss again at the end of this video as kind of form of a case study. But we're going to be thinking about Shopify as in the present. Is it presently a good opportunity? Okay. Now, psychologically speaking, I would be okay with actually buying back in if it is a good value, if I presume to be a good value, right? This is technically a mistake that a lot of people go through. So for example, and I'm guilty of this, I'm just telling you right off the bat, if something is higher than when I previously had sold it, I do find myself that I end up struggling with actually rebuying the stock, right? That's technically not the right framework or the right mindset to have. It should be exclusively on the present scenario, right? It should not, your past decisions should not affect your future decisions to that capacity or to that degree. Now, if we presume that today it is a good value, it will be easier for me, psychologically speaking, to buy back in simply because I did sell at a higher price point, right? even though that shouldn't be the case. So I acknowledge this, and I'm sharing this with you guys here, that if you acknowledge that you have those same behaviors, try to acknowledge it and work on it. Of course, nuance, right? Sometimes you have to be, it's under the presumption that it is a good value today. Okay. Very, very important presumption to make. All right. But anyway, this company has done tremendously well. And actually, if you take it from the beginning up until the high point, it's done absolutely insanely, right? We're talking about nearly 6,000%, right? And that's not much time. So definitely a market beater right here. So then what happened, right? What happened? Well, I think it's fairly obvious. There was a switch or conversion to e-commerce. Shopify is what I call an enabler, right? It is a technology play, but specifically in e-commerce, what it is an enabler, right? They profit from you setting up your store with them, right? So you are the merchant. You technically have all the risk. So it's a great business to be in on their end because they don't really take on that risk. So they just take a little bit off your top, right? Because they also provide you with a bunch of other services, and then they can sell you a bunch of ancillary services that also allow them to profit from that capacity as well. So I think all of you were around on YouTube, as far as watching videos on YouTube in this era, where you saw a ton of drop shipping advertisements, right? So again, we'll discuss more of this on the risk side, but a ton of drop shipping advertisements from some questionable people who are jumping in on this trend, trying to sell courses regarding that and stuff. But the point is, that's one way for us to visualize or really understand the era of drop shipping really just occurred, right? It still occurs to an extent. There are a lot of businesses that are now much larger that started from that era, that are now, still operating and on a larger capacity. So Shopify benefits from that. So if you start with them early and they incentivize you to stay with them for the long haul, they do profit from your growth, right? Their services are essentially trying to make things easier for those people who want to start an online business regarding e-commerce, specifically in like selling merchandise. And then again, it was used a lot by the drop shippers, so to speak. So Shopify, again, I call it an enabler. Now, actually, I'll save that for later. I'll save that later. But if we take a look, for example, at the letter, this is the letters from Toby, and the most recent one was 2018. I assume he's due for another letter, or at least a letter from the CEO. So basically, if you read this letter, which at the time I had, but the basics or the crux of this letter is basically that they are attacking a niche that is expanding beyond anything, right? That's basically it. So right here, I want to highlight this line right here because this is pretty important. So their merchants sell on Amazon, eBay, Facebook, and Instagram, right? Right there, this is pertinent for later on. They're selling on third-party sites, not Shopify site. Remember, Shopify is an enabler, okay? And then this was something that they were rolling out back in the day, Shopify Pay. That was a version of Google and Apple Pay. Think of also like PayPal as well. And then they also utilize these shippers right here, right? So what do you guys think about that, right? I'll let you pause here. Okay, the answer is they are an enabler, right? So back to what I was saying, they're an enabler. So they enable you, the entrepreneur, to have all these services all in one place, and they try to make it easy. So you can quickly set up a shipping department, whatever. You can quickly connect to these third-party sites where you can sell on Amazon, eBay, Facebook, and Instagram. Okay, so they're enablers, right? And this is a Canadian company, by the way. This is, I think, a Canadian darling. And then you see right here, transitioning from online store software, because that's how I want you to think about this. This is a technology company at heart, right? It is not to be valued as an e-commerce, even though I'm putting it into the group because I'm doing a Shopify, Best Buy is coming up, and a couple others. And then after this, I'm going to switch over to just pure software companies. So kind of like this is the middle point between that because it's software relating to e-commerce. Okay. But I just wanted to let you guys know. Oh, I guess I need to say this too. This has nothing to do with the, my co-host that I go on Strongman's. It has nothing to do with the whole Meet Kevin thing. Yeah. So just so you know, this was just on the list. It just so happens that its turn came up while they were both talking about it. So yeah, it has nothing to do with that. This is just for you guys. Okay. So for my subscribers. But anyways, looking over here, for the first time, the software addresses the real needs of merchants. So you see a lot of the lingo here is pertaining around being an enabler. This enabling is what is what basically allows all these merchants to provide these products to you at a more convenient time. And then it basically enabled, you see that I'm using that word, enabled a lot of people to start businesses. Okay. And then there is a huge degree to as far as how far Shopify went, right? Because you had Squarespace, you had Wix, you had a couple other services, GoDaddy, but they were all not as good and as specific as Shopify was. So Shopify really was there and really made it easy for people to specifically focus on e-commerce. Okay. So of course they are a much bigger company than this letter when this letter was written. But again, we'll get to some of the risks stuff when we get there. All right. So I want to take us over to the balance sheet, and let me zoom in for you guys who are watching on your phone, because I want to be, I'm getting better at remembering that, by the way. So I'm becoming a better host over time, hopefully. And then you guys let me know down in the comments below. If you guys watched one of the original videos, I think I've gotten better at communicating some ideas, because before, you know, I'd be like, why don't you understand? No, I'm kidding. I was never like that. I like to break things down a little bit more and explain them. And I'm trying to be aware or cognizant that every viewer might be at a different level in terms of their journey, specifically and learning these things. So nothing really sticks out in terms of the asset side of the balance sheet. But then when we go over to the liabilities, I noticed that there's something missing, and you should think long-term debt. Well, they have no long-term debt, which is really good. Of course, by the way, if you have any questions on the specific accounting line items, go ahead and comment down below and I can answer those questions for you in a timely manner. And we also have a lot of CPAs that do follow this channel. They might be able to answer it as well, if I don't get to you in time. Okay. But one thing I do want to say, which was, yeah, their goodwill is not that much, which is great. So their intangibles aren't that bad. Property, plant and equipment, or property and equipment, you see how it's a very small piece, right? It's a very small line item, which is actually indicative that this is a very asset-light business. You know, it's a software business. That's why I want to kind of highlight to you guys there. Looking at the cash, they have a decent amount of cash. 2.5 billion is nothing to scoff at. It is going down, so I bet you they're making more investments. Or right here, this is actually my mind. And I haven't looked at this previously, so I'm looking at this in real time. So if you see me pause, it's because I'm thinking about something. So marketable securities is rising. Basically, marketable securities is things that they're putting that cash to work in to generate an extra return. Marketable securities, that you see they have it right here. And this is how you can kind of read a note. So they have note 5, which you can scroll down here and you can find note 5 when they list it. But it's not here, by the way, but you would scroll down and find note 5, and then it will explain specifically what it is, a little bit more information, because marketable securities is like the basic name. And you'd be like, okay, well, what does that mean? Well, you'd see what it means in note 5. Okay. Now, this is a breakdown of the revenues, and this is where I want to focus more on, because this gets you an idea of what their business is like. And remember, I told you they're an enabler and they don't actually carry a lot of the risks. So subscription solutions, when you have a Shopify account, you are paying a subscription and they are basically hosting your site, right? Which is great because that is, again, no risk to them. They make money right off the top, whether you make money or you don't make money. And then you have the risk that you have to make money, okay? And then the merchant solutions, these are the ancillary services that I was talking about that they add on top of that. And they say, okay, well, we can do this for you. We can do that for you. We can do this for you. We can set up communication lines between you and that party and that party. And that allows them to make more and more money, right? And at some point, I think they probably put that in there at some point where they're also collecting a percentage, because I think that goes probably in merchant solutions. If I had to bet, I bet that goes in merchant solutions. Again, that would be specified in note 23, but we don't really care about which one specifically it's located in. So subscription solutions, if we take a look at the cost, definitely you see that that's indicative of a software business. The margins are really high there. Merchant solutions going to be a little bit less, and that's understandable, but still pretty high. Okay, nearly 50%, which is very good. Gross profit as overall comparing to revenue, again, is very good. It's a little bit over 50%. So like to see that. And then I'm seeing here sales and marketing isn't that much really relative to what we think. So it is growing, but we can see, for example, this is growing by 50%. And this is growing by slightly over 50%. So they are scaling. This is indicative of scale. Okay. So Uh, let me actually think about that for a second. So they're basically growing. Let me make sure I'm checking my math. Yeah, that is over 50%. Okay, good. Because we can see this grew by nearly $1 billion, right? Nearly $1 billion. And this one grew by 300 million. So that's about 50%. So this would be 750 million would be about half of this. And so, yeah, it's growing over 50%. So that's good. That's scale. That was just some quick mental math. I'm not bringing up the calculator or anything. Interest income, that's probably come from their marketable securities, if I had to guess, because they're not probably buying stock. They probably want, some short-term bonds and stuff like that. But regardless, that's pretty much most of the stuff I want to really highlight. And then we'll get to the model. So the model already has Shopify put into it because I didn't want to waste any time. So let's go over there and let me zoom in again for those of you who are on your phone. Let me actually come over here. You guys can pause there. If you guys want to see the gender of the executive team, the year they were born, if available, and their pay, if available. All right. So coming over here, analysts have a price target of $893.16, implying a 29.27% upside. Okay. If you take a look at that beta is quite high. Not the highest, obviously, that we've ever seen, but it's decently high. It is a little bit more volatile than the overall market for obvious reasons. And we take over here, looking at the PE and the price to free cash flow, we do see that they are having a lot more in GAAP net income relative to the cash flows of the business. Okay. Now, why might that be? Well, we have to consider the R&D expenditure. The R&D expenditure might be a decent amount, or they're expending a lot in capital investments, which if we, again, let's go back here and investigate that for ourselves. And then we see right here. So this is the consolidated statement of cash flows. We can investigate that a little bit more right there. And here's, no, it's purchase of marketable securities. So we have operating activities, and then we don't have any sort of, oh no, we have it right here. So we have some of it right there. Yeah, that's fine. So no, they have a decent amount of cash, but looking at the net income, definitely not the same amount. And then so this is actually what's drawing it down. So the net income is actually being driven heavily by unrealized gains. So they're actually redacting those unrealized gains. And then so their net GAAP net income is actually not really that high. Okay, so we actually have to consider that they are not, repeat, not making that level of net income, and it's a lot of it is on paper, okay, not real. Okay, so that's interesting to note, but that's specifically for this year. In the past year, they had very little GAAP net income, but a lot of cash flows in comparison. It was over it. All right, so looking for the longer term, I'd actually take a look more at the cash flows than I would at the GAAP net income. This is a fluke. Okay, so this is a fluke again, because we can't consider that as actual cash flows. But let's actually then go back to the model. So let's actually remove this and let's say nope. Okay, because we're not using that one because it's not an unprofitable business. And remember that the average growth, right, is about 64.49%. Will this continue going forward? Well, let's actually assume that they hit 70% at the highest end. All right, and I'm trying to make a point here. Let's lower that discount rate to about 20%. And that was not what I wanted. 20% in total. Okay, so you see at 70% growth, right? That's the implication. We see that it was still overvalued at the highest point, right? If you wanted a really good return, let's change this over to a 10%. So at a 10%, these level of growth rates are pretty insane, but I don't think they're going to grow at that, by the way. I think a lot of people might be confused. They might click off the video. They're like 70%, that's way too high. Don't worry, I don't think they're actually going to grow at 70%. I'm just going that, like, that's an extreme case scenario, but they're somehow like able to achieve it. It's thrown in there. All right. I would say we're going to use a custom weighting, and we're going to value that at nearly a 2% probability. That should probably be maybe a 1% probability, if I'm being honest, but we'll keep it at 2%. And then a 40% would be a deceleration still. Deceleration, it would say that right now we're pretty much at fair value. But if I'm being honest, I think going forward, they're going to grow at probably like 30, 39% and, or not 39%. I don't know why I said that, 37% and below. But let's actually keep it at 40 and then we'll go. I did it again. See guys, I'm little bit of a silly goose sometimes. All right, so 40%, and then let's lower it down to 35%. And then we can say 30%. And then on the lowest end, let's go with a 10%. All right, a probability of a 10%. And right here, the model's not liking it too much. So it's basically saying the recommended portfolio weighting is negative 0.46%. Definitely not a risk of bankruptcy. Makes sense because we took a look at the balance sheet. They have no debt. Okay, we have two pricings here, obviously, because this is a Canadian company. Country is Canada. So a lot of the currencies are priced in Canadian dollars. So then we make the conversion to US dollars. Okay, so this is the US dollar variance. So again, not at risk of bankruptcy, not many liabilities, no liabilities in terms of long-term debt. So it kind of makes sense. So we have the Altman Z-score saying no, and then the company, the model's own measure is saying no as well. Okay, so want to see something here. This kind of makes sense. Equity heavy. It is equity heavy. Again, I got to get on these. By the way, I've just been really busy at work, so haven't really been able to program these to function again. But it shouldn't take me too long once I really sit down and do it. Right. I'm kind of in between, like, okay, work on the back end of the model, or for these metrics that I like to have as a visual, but I don't really need that much, or make videos, and I chose to make videos. So let's take a look at some of these ratios. I think let's get rid of the noise and let's move these away. Take a look at the 5 years. We have a fantastic liquidity ratio set up. It is getting worse from 2020, but that's fine. It's still get better overall. Solvency ratios are pretty good. Again, you can always pause here and actually just take a look. And I have this column right here that tells you what direction is better, higher or lower. Return on invested capital looks not too good, but it's fine because of what we're kind of perceiving. I'd for this entity, I'd actually pay more attention to the return on assets and return on equity going forward, rather than the ROIC. But slowly but surely, ROIC is going to become a very important measure for this business. It's kind of like, because of the stage they're in right now. So a little bit different playbook you have to take. And earnings quality, it's not too good, actually. It hasn't been too good. But this is, remember, I always say there's correlation, not causation. This has been a tremendous performer price action wise, even though the model's been giving it a bad grade in terms of earnings quality. All right, so interest coverage, obviously, we're good on that. We're good on that. All right, so let's go back and see some of the sentiment. So sentiment's pretty good. It's pretty decent, actually. And let's see what everyone's kind of saying right now. Is Shopify stock a buy or sell? Investors' place. What's going on with Shopify stock? Shopify loses 60% of its worth since November. Investors suddenly see value. Okay, I don't know what that is. 3 reasons to buy Shopify, 1 reason to sell. Okay. Basically, a lot of people are talking about Shopify, and you can see the dates here. This is actually fairly recent. We are making this video on the 21. So we have 1, 2, 3, 4 articles just now published. And yeah, no, pretty good. Okay, so a lot of this company is very well covered. A lot of people like to talk about it. Again, I think it's the largest Canadian software company. I think it is. Don't quote me on that, but I think it is. So it better give that. By the way, if you're looking down at this sheet's just here if I ever need to do some math for you guys and show you guys something. So that's what it says, balance sheet example. All right, so back here, let's actually kind of discuss, and then we'll finish off with the risks. What is an appropriate discount rate? Well, that entirely depends, or what is your required rate of return? That depends on you. At a market average return is what you're looking at. I'd pay attention to take a look at these buyback rates, or not buyback rates, dilution rates. So for example, if they dilute at around the same amount, this is not a compelling buy. Okay. So let's kind of backtrack that a little bit right here. So if there is no buyback, like we say 0%, right? Let's say they do a 1% buyback, right? A 1% buyback would yield around there. But let's say they do the dilution, right? Dilution, let's go back, 5%, right? I just wanted to walk you guys through that. So a dilution rate of 5% does impact the return potential a lot. We can see that this went from 4,000 down to 2,700. This is no longer in the buy range. Nothing's in the buy range. The model's not liking this at all, which is quite interesting. But remember, this measure is based off of a ton of different potential variations. So even though we're weighting this at a higher end over here, it is, taking into account bankruptcy risk and all that. So, and a bunch of other things, but just sticking to that. And if you require, for example, a little bit of a margin of safety, this is the assumption, or these are the buy prices the model's kind of spitting out. Let's actually start changing these to see kind of what it is that we have to expect. Around 60%, exactly that. Wow. Okay, that was, I haven't looked at this before, so that was accidental. So around 60% growth every year for 10 years. Is that possible? Sure, whatever. But like, is that probable? Ooh, like, they're growing off of a decently sized base now, but there's plenty of room for efficiencies to be realized in the cash flows. So it is a possibility. I think it's appropriate to rate that, in the total of these two being about 10%. Yeah. But even then, we were seeing at higher assumptions, at higher requirements, the model is actually disliking it more and more. So right now, that's pretty much where I'm at. But Shopify is, as far as a business goes, a high quality business. Let me say that before I say anything further. Now, I think I'll segue now into some of the risks, and the risks are very important because we have to worry about the risks more than anything. So remember, in the beginning of this video, I stated that Shopify is an enabler, right? It enables merchants to conduct business, and in doing so, it has pushed away a lot of the risks over to the consumer, right? Or their consumer, okay? Their consumer is the merchant. The merchant is the business owner, the entrepreneur. They have all the risks. So Shopify doesn't have all those risks. Shopify will benefit if you succeed or if you fail, right? But they would prefer you to succeed, obviously, because then you can build a long-term relationship with this client. And then Shopify is very scalable. We've shown that in the evidence by the margins. The margins are scaling, right? So we see that the marketing budget, for example, is growing at a slower pace than the gross profits. Gross profits are growing at a faster pace. This is a positive sign. This shows us that they are reaching a scalable point, right? And I think that's pretty obvious at this stage where they're at. But what are some of the risks? So what we noticed in the letter, right, is that they sell in a bunch of third-party platforms, right? Their customers are beholden to the solutions, right? Their businesses are beholden to these third-party platforms, such as Amazon, right? So Amazon, let's stick to Amazon as an example. Amazon is a tech company. Amazon, of course, has AWS, which we've talked about each time we've mentioned Amazon, that if you're not looking at AWS, you're not looking at the right Amazon, right? Without AWS, Amazon can't really do a lot of things that it does. AWS is a cash cow that allows them to be a loss leader in other segments, right? And retail or e-commerce is one of those segments that they're going through a tremendous amount of transformation in a positive light for Amazon shareholders. One of those is the expansion into third-party selling. They are basically building out the infrastructure to enable merchants to sell directly on Amazon. And then you have fulfillment by Amazon, for example, and that's the one I'll stick to. So fulfillment by Amazon allows you to, sell on Amazon, and you don't actually need a Shopify store. The Shopify store makes you have something that, makes look nice and stuff like that. But Amazon, you don't need that to actually sell on Amazon. So that's one concern I have right there, is the reliance on third-party platforms to actually conduct business is a weakness, is a chink in the armor. Now, they have, I think, the best of the best in terms of ease of use for a merchant to set up an account and begin selling, and ease of connectivity to all these third parties. So it is a good place, like a good hub. They're trying to be a hub, actually. That's a better way of explaining it. They're trying to be the central hub for which a merchant goes through them and then accesses all these places. And there is value there, because that's a lot of administration if you're individually dealing with eBay, individually dealing with Amazon, individually dealing with Instagram and Facebook, right? That's a lot of administration time that Shopify is there for you, saying, hey, I'll be there for you. I'll make it all in one place. So it makes it easy for you to worry about other things, right? But longer term, as brands grow, I don't see them sticking with Shopify. I think, for example, don't quote me on this because I don't know exactly if this is the case, but Gymshark, which was a small brand back in the day, is now a large brand. I think it's valued at over $1 billion, something like that. But I'm pretty sure they did start on one of these third-party website creators, right? Or website hosters. And then after they got large, they segued out of it. And now they're independent. They built up their own infrastructure and stuff like that. Similar to how I mean, I'm nowhere near the size, but for example, capitalmindset.org was hosted before on a third party. And then immediately I had the ability and capability to get off of it, right? So with that being said, because of the longer term picture of what I think Capital Mindset will be, I don't want to host it. I want to have complete control over the full stack for Capital Mindset and anything related to Capital Mindset and the information it will provide. I don't want to host it on a third party. Of course, the security services will be, of course, third party, but I don't want the hosting part to be third party. I want to be able to fully customize the way it looks and everything, and basically add as much things as I want, right? Shopify, of course, for those people who don't know how to do such thing or don't have the ability to do such thing, they're starting very small, is perfect for that. Okay, so again, primary risk is the reliance on third-party services, which makes me a little bit cautious going forward. And the barriers to entry in that sense aren't very high when we consider that. For example, who has a higher barrier to entry, Amazon or Shopify? Definitely Amazon, because look at the capital investment necessary to build out that infrastructure. Can Shopify build out the same level of warehouses? They have $2.6 billion in cash. Amazon has tens of billions of dollars in cash, with tens of billions coming in the bottom line every single year, right? Tens of billions. And when we're looking at the cash flow expenses, they're able to expense a ton of cash flows into growth CapEx, which Shopify simply is not able to do. Now, does that mean Amazon will destroy Shopify? No. They're different. And I think Amazon, back in the day when I was investing in Shopify, there was the fear that Amazon would come in and disrupt Shopify, right? They tried that and they actually didn't succeed because Shopify focused on that niche. And again, when you have a bunch of niches, there's plenty of room for small players to succeed. Size doesn't necessarily mean victory, but size does help in terms of scale, in terms of future offerings. And Amazon is a scary guy to go up against, of course. And I think everyone kind of knows that. We call that, or I didn't coin the term, but someone has coined the term, the Amazon effect, right? Amazon just enters your space and just comes at you. One example of a recent investment I made, and it's in the portfolio, and I think now we're doing really well. For a while, it was doing nothing. Cardinal Health. Let me actually take a look at where Cardinal Health is at. I will be doing a portfolio update video, but I just want to see what value is Cardinal Health at in terms of the gains in the portfolio. But the issue, right, with Cardinal Health was, and I'm up 21%, that 21.09%, again, that's in the public portfolio, that's free of charge to go look at. Cardinal Health is now at $57.29 with an average cost of $47.31 as I'm reading it from here at the present moment. And one thing that was going on with that business at the time was the Amazon effect, right? So there was a fear that Amazon was going to come in and cut them out. And it turns out Amazon's not even focusing on their end of the business. Their end of the business is the triopoly between them, McKesson, and AmerisourceBergen. But Amazon's coming after the lunch money of something like a Teladoc, right? But that's aside from the point. That's the Amazon effect, right? Shopify has kind of gone through that already. Will that continue going forward? I don't know. What about Facebook? Meta is another potential competitor, right? Facebook or Meta is investing a lot in the metaverse. And I'm trying to tell everyone, the metaverse, there's like the meme saying of the metaverse like Ready Player One. And then there's the more practical side of the metaverse that I think is where the direction Facebook's trying to go. If you just pay attention, for example, to what Dropbox is how they're trying to position themselves within the quote unquote metaverse, it starts to become a little bit more clear that the metaverse is not simply a virtual reality. It is more than that. It's going to be a business connectivity space, right? It's going to be a second version of the internet, right? To some capacity. Where does Shopify play a role in that? Can they adapt? I think it is a very good possibility, but I don't think it's not something I'm entirely comfortable with. And then again, that's kind of circling around the risks, and that's hopefully drawing everything into a conclusion for you guys. So hopefully that makes a little bit of sense to you guys. So for this business, I'd be a little bit more hesitant at the present price point. If the price was significantly lower, let's say it was below $200 a share or even $100 a share, I would say the risks are at the present moment, I'd be comfortable with entering a position. I don't need to own the stock, so I'm not in a rush to own the stock. And then at some point, I'm going to cover Mercado Libre, which is a little bit more interesting in terms of the business prospects to me than something like Shopify. Okay, that doesn't mean that Shopify is a low quality business. To the contrary, high quality business. But again, those risks I'm just not entirely comfortable with. All right, on that note, guys, let me know if you guys enjoyed this video. If you guys did, go ahead and feel free to leave a like. If you guys aren't subscribed, go ahead and subscribe and come back to the channel, and we might be covering a stock that you're looking into at the present moment, and I can probably shed some of my thoughts with you. And if you guys have any requests, go ahead and leave them down below. For now, I'm still taking requests in the comments section. I'm trying to, again, figure out a better way of doing that over time because, the list is long and getting longer. On that note, guys, I'll see you guys on the next one. Have a good one.